Welcome back. Now let's look at the second of the very common tax minimization strategies, and that is to increase deductions or tax offsets, essentially to bring forward some expenses. So let's say that in your planning, you knew that you were going to buy, let's say a vehicle. You were going to buy a vehicle in the next financial year, but based on your current financials, you decided that under advisement from your accountant that maybe it might be beneficially tax-wise, rather than buying it next financial year, to bring it into this financial year because you'll save some tax. So let's walk through that. Let's isolate just that variable. And so if you watched our first video from before, you would have seen that in the first video we had deferred some invoices so that the revenue was less this financial year. So what we're going to do, just to compare apples and apples, in this particular case, we're going to keep revenue the same. So now it's the same business of 1.25 mil revenue, and these are its standard numbers, assuming that everything stayed the same for this current financial year. Now, let's say the same business owner decided that let's bring forward that purchase. Let's say it is a vehicle. Let's bring it forward, and so rather than having 350k in fixed expenses or overheads, we now this financial year are at 400k. And so what's the effect of that? So again, if we go through all the numbers, we can see that our basically our tax bill at the end of the day is now only 103k instead of it being 115k. And so essentially, we both in this financial year we get a car, we get this asset, whatever this fixed expense is, and we get to pay $12,500 less in tax. So what can be wrong with that? What's wrong with that? Nothing. And so let's now have a look at the same action and the effect that now has on your business value. So again, we're going to use the same conservative 2.5 earnings multiplier from before, and remembering again that we're going to be multiplying it by our EBITDA. So if we kept our current financials as they were and we didn't purchase that asset, whatever that was, that fixed expense, basically using our EBITDA of, in this case, 462k, we're now going to have a business value of just over 1.15k. Now, remembering that in this particular case, we've now purchased the asset, we've brought it forward into this financial year, we purchased it earlier than we really wanted to, but we thought to save tax. What's the effect on our business value? Now we can see that our business value, still nice, we still get it past the $1 million mark, but we've actually lost business value of around $125,000. So essentially the effect here is that in trying to save $12,500 in tax, we've actually foregone $125,000 in business value. So yet again, another 10 times multiplier. Now, what's the net sum again? And again, once we'll factor in the entire calculation again. And you may recall from our last example that in a similar way, because by keeping our current financials as they were, we would have actually booked in an extra $50,000 of profit. We now should factor that in as well in looking at the financials of our current statement, of our current situation. So because we've preserved our 50k profit, we've kept that. Yes, we've foregone the $12,500 tax saving, but that means we're still net $37,500 better off keeping our financials as they are, and we're still better off $125,000 by keeping our EBITDA high. So therefore, our net benefit to keep our financials as they are is $162,500. Whereas by going down the tax planning route, our net benefit is that we've saved $12,500 in tax. So essentially, the net result is by trying to save $12,500 in tax by just doing this one action, we've actually foregone $150,000 in business value. So an over 10x result. Let's have a look at the next tax minimization strategy. I'll see you in the next video.